So I get asked this question a lot. Should I buy this property in my own personal name? Should I put it in the company name? Should I create a new holding company, let's call it, which, by the way, that's called an eligible passive concern, an EPC. Oftentimes people will form an LLC to do that, although I've seen LPs and triple LPs and all sorts of weird entity structures. I'd say probably 90% of our customers form a holding company, that EPC, to take title and own the real estate through. Okay. What that means is the operating company is continuing to pay a monthly lease. You've got a master lease that ties the operating company with the EPC. There's a master lease between the two. But what happens is if you're the business owner that owns the EPC as well, now you're getting some tax sheltering in the EPC. You know, you're taking the depreciation, you're taking the interest expense right off the amortization, all under this new holding company, as opposed to just, doing it in the business. It tends to add an extra layer of protection in terms of liability. And I think it's good for estate planning, for general tax strategy and just general planning purposes to do it that structure. It makes very good sense. SBA approved this many, many years ago, this type of a structure. It's not a problem. And frankly, it also doesn't make the business, the operating company, it's not a drag on ROA, which would be an important metric if you have dreams of taking your company public one day, and ROA, return on assets, is a big deal for Wall Street. If you've got it as a separate entity off into the side, the company's just paying its regular lease payment, then that doesn't come into play. The other reason to do it, that structure with an EPC separate from your operating company, is one day you're probably going to either do one of three things that happens to almost all small businesses in America. You're either going to sell your business, you're going to shut your business down because you've been running it for 30 years and you're tired and you want to retire, or maybe you'll get lucky and you can take it public. But it's one of those three things. If you actually had the brilliance to do this, to buy the commercial real estate and set it in a separate EPC, a holding company, you've almost got another bite at the apple if you think about it. If you sell the business, okay, now your buyer may become your new tenant of the property. That's one possibility. Or maybe you sell the business and they don't want to have anything to do with your commercial property. Well, maybe you've been paying for that commercial property for a number of years, building up equity into this appreciable asset. Now you're going to go out and find a new tenant. And now you're basically, getting rent checks every month after you've sold your business. That's not a bad situation either. It's actually a really good retirement strategy for a lot of folks. But you might get lucky, and maybe the acquirer of your business also wants to buy the real estate. Now you have two bites at the apple, so to speak, if that occurs. If you shut down your business, again, now you can go ahead and rent out the space. Again, hopefully you can find a tenant who wants your property, and you can cash rent checks again. Or you shut down the business, you decide you just want to sell everything, shut down the business and sell the property that goes with it. That's fine. But the point is, this gives you flexibility. This gives you options. If you're smart enough at some point in your business career to say, gee, I don't want to keep leasing. I don't want to keep making my landlord wealthy. I want to own this property myself. It gives you options down the road when you get to that point, that fork in the road, and you decide what you want to do with this business going forward.